Imagine a world where the safe balance between stocks and bonds is suddenly thrown into question. For investors managing diversified portfolios, one pressing question stands out. If inflation falls below 3%, will the negative correlation between stocks and bonds return? This is the trillion-dollar question shaping modern portfolio strategies. Before 2020, bonds acted as a reliable shock absorber for stocks. But a recent shift to positive correlation, both stocks and bonds moving together, has shaken the classic 60-40 investing playbook. Why did this shift occur? And what would it take to tip the scales back? Let's break down the connection. When inflation is high or volatile, central banks raise interest rates. Higher rates push down bond prices and squeeze corporate profits, causing both stocks and bonds to decline together. In contrast, when inflation is low and stable, near central bank targets, the tide turns. The market's main concern becomes economic growth, not inflation. If the economy falters, stocks fall. But now central banks have room to cut rates, which boosts bond prices and restores that negative correlation investors rely on. However, this isn't a guarantee. Even if inflation dips below 3%, negative correlation may not return right away. Several structural factors can stand in the way. First, if inflation remains volatile, even at lower levels, markets stay on edge, pricing in the risk that inflation could surge back. Second, massive government deficits and the swelling supply of bonds can keep yields high, making bonds less effective as a hedge. Restoring negative correlation requires more than just low inflation. Markets need to trust that central banks can keep inflation under control without sudden rate hikes. What can investors do when stocks and bonds move together and the traditional safety net is compromised? One path is investing in real assets and commodities. Gold, oil, and agricultural products often respond differently to inflation, while real estate and infrastructure can pass rising costs to users, offering a form of protection. Another strategy is liquid alternatives. Funds that mimic hedge fund tactics, like market-neutral or trend-following approaches. These aim for returns regardless of whether markets rise or fall, and often provide true diversification during shocks. Cash and short-duration bonds also play a crucial role. With less sensitivity to rates, they preserve capital and keep investors nimble for new opportunities. Floating rate notes, whose payouts adjust as rates rise, can also shield portfolios. Lastly, factor investing tilts portfolios toward qualities that withstand inflation stress. Strong balance sheets, low volatility, and value stocks have historically shown resilience in these environments. In today's uncertain market, understanding the mechanics behind stocks-bonds correlation and adapting portfolios with new strategies is key. The future of diversification rests not just on numbers, but on trust and stability. For investors, remaining informed and flexible ensures confidence, no matter how inflation and correlation evolve.